So, good evening, everyone. I hope I'm audible to everybody. So, thank you very much for joining on a Saturday evening on a Valentine's Day for this session today. So, this session is all about SIF, okay, and simplifying SIF because SIF is something which has been recently introduced by SEBI, and it's a very, very interesting product proposition. I'm sure many of you know a lot of details about it. But we have, two experts here from 361 Asset who will be diving deep into what SIFs are all about and will be here to answer all your queries. But let me just begin as to what was the basic premise for this specialized investment funds. Typically, the minimum gate for any investor to invest in this product is 10 lakhs, right? And onwards. You cannot invest 10 lakhs collectively in a fund's SIF. Like, for example, if there are three SIFs on the equity side, which one AMC is launching, you cannot say, I will invest three, and four. You have to invest 10 lakh per SIF. Correct? That's the minimum gate. And most importantly, SIF certainly gives some more leeway to the investment management team, which Harsh and Raghav will tell you more in detail as we go along. But what is important here is that when we saw this euphoric rally in the market post the COVID, I think a lot of unregulated, sort of soft PMSs started operating in India, where anybody who not holding at least 50 lakh, which is the minimum ticket required for a PMS, they started taking these investments worth 12 lakh, 15 lakhs, 14 lakh, and managing these PMSs which were completely unregulated. And of course, anything which is unregulated has a high chance of, negative situations arising, risks arising, loss of money arising. So I think it's a very, very good attempt by the regulator that they announced a product like the specialized investment funds, because through the asset management companies, an investor investing 10 lakh and above can introduce himself to a higher asset class, which gives him slightly more risk and hence a slightly higher alpha in a much more regulated environment through the asset management companies and governed directly under the nose of SEBI. Correct? So, of course, this asset category will certainly become very, very large in the times to come, just the way we saw mutual funds going and increasing. So what we will do now, straight away, we will jump into the webinar, and I have lots of questions for, Raghav as well as Harsh. So we will start shooting these questions to both of them. What we're going to do is at the end, we will open up, for Q&As. Please put your questions in the chat and we'll pick up these questions, as many as we can, and we'll try to answer them. Thank you. So Raghav.
Hi, Suren. Thank you so much, Advisorkhoj, and thank you so much, my dear viewers. As Suren said, happy Valentine's Day. It's not the best way. I'm sure some of you are imagining spending Valentine's Day afternoon, but we try and. But Advisorkhoj is known for its knowledge-first initiatives, and I think this is a very, very, very important fund or very, very important category for all of us to know a little bit more about. One is because it's got associated with derivatives. I think there is a lot of misconception about what you can do and what you can't do. Number two, of course, there is that whole 10 lakh rupee gate, and there is possibly a reason for it. Number three, as you know, all of us, including 361, have to come out with a separate name. So in our case, we're calling it Dyna SIF. Dyna obviously stands for Greek word which means dynamism. I think this product is extremely dynamic from a perspective that you can do a lot more in this portfolio, which you cannot do in, say, regular conventional investment avenues. Right? In some sense, this is a India first product, because in the first time we are actually introducing to a large audience products which have a bit of a hedge fund field around it. So ideally, what this product does for us in a one-line statement is it provides some type of shock absorber on the way down when markets go down, and obviously try and give you a boost on the way up, right? I think, and this is using derivatives. Interestingly, it also does very, very well you in flat and volatile markets, the kind that we've been experiencing, especially over the last 18, 24 months, right? And if the pundits are to be believed, is possibly our state of markets, at least in the near term, right? Uh, I must start also by telling you before Harsh jumps into the PPT, is that this is, as the word specifically says, it's specialized, right? So that means there is, you have to be you have to go to an investor who already has some ability or has some experience in capital markets. Uh, However nice this product looks, however great the product literature looks, please do a lot of client profiling before you. My don'ts is typically three things. Don't take it to a conservative investor, because these, especially this fund, is a pure equity fund. Equity comes with its level of risk. Number two, try not taking it to a first time investor, because obviously the strategies that are here are going to be ideally suited for someone who has seen some swings in markets, and especially people who have seen a couple of cycles. Markets move in cycles, as you all know. We are possibly going through a flattish cycle right now, but have you been so unless someone has gone through an entire cycle, he won't really appreciate what you're trying to tell him, or he or she is trying to tell him. So these are the three things I like to say. It is risk band 5, so in that sense it's a high risk category. But yeah, contrary to what people think, and Harsh and I will try and put some more light on this, is that this is not a really a very risky fund. If managed well, if we get our stock selection right on the long side and obviously on the short side, I think the risk levels actually diminish. And this is I'm talking about in the nature of a equity fund, obviously, and there are 7 categories of schemes that can be launched. So you can effectively have the whole bucket. This is not really focusing only on equity or on hybrid. The regulators allowed the industry to do 7 sub schemes. Right now, the only advantage I can think of from an MFD perspective is very, very useful, is that it's very similar to your entire mutual fund onboarding, right? Except you have to give an exam. It's a tough exam, so please take professional help when you are giving this exam. It's not typically learn it yourself kind of a paper, unless you are dealing with derivatives and you have some live experience there. Please don't attempt it. It's got negative marking, and the paper is quite it's quite an expensive exam. It's a 3,000 rupees a pop. Number two, obviously, once you get that certification, you don't need anything else. You just attach that certification, apply to CAMS, and automatically your ARN will be flagged for approval to sell these products. In which case, then you get the same commission structure, the same disclosure, the same APIs will throw you the data in terms of account statements and everything else that you are used to seeing in your normal mutual fund transaction. Right? Lastly, just because I know this is a little complex here, but we cannot start this product with an SIP. I mean, there are mutual funds today where you can start your investment journey with just putting in a SIP amount and then continuing it. Here, the investor will have to start, like Suren mentioned, with that 10 lakh rupee application. And then, of course, there is a 20,000 rupee minimum SIP, and then obviously much higher. I think it's fabulous for my MFDs for 2 reasons. One, it allows you to really scale up the client business. Right? Today, frankly, given the economics of the trade, doing a 5,000 rupee SIP is great, but doesn't make you money unless you're really going to stick, unless the investor sticks with you for a very, very long period of time. And as you all know, the statistics tell us that about 30% of the SIPs only make it past 5 years. So you guys have to have some product and some offering which gives you a slightly higher ticket size. That's number one. Number two, like I said, it's mutual fund related, so you get the same. You get a good trail commission. Trail is based on the NAV, so that's very, very good for all of you, because you're really participating in the growth of the scheme along with the investor, along with the asset management company. Same thing, the same partnership principles apply. Lastly, I think it's for people who have a beautiful SIP practice. I think this solves one problem for you as to how to take your average ticket size up. Obviously, like I said, it's not to be taken to all customers. It's a bit sophisticated. But what we're going to try and do in the next 20 minutes is to try just 20, 25 minutes is to try and just give you a little more principles around this product. And then more importantly, where in what circumstances does it work, like markets, bull markets, bear markets, what's the sort of experience you should be getting. Uh, and lastly, of course, if there are any questions, like Suren said, we're very happy to try and attempt some of them, right? So I'll stop here and I'll hand it over to my colleague Harsh. Harsh, unlike a traditional fund manager, has been a hedge fund guy for the last 15, 20 years. Now, we're fortunate to get him at 361. He started his career with a prominent hedge fund, a global hedge fund, and then he moved to a large treasury where he was part of their proprietary capital management. And I think in this decade, he spent the first few years of this decade from 20 to 24 with a very large asset management company, Tata's. And he at one time used to run the largest long short fund, which is a very close proxy to a SIF equity option, right? So in that sense, unlike many people I have met in my life, Harsh comes with a huge amount of experience in this particular category. You need a slightly different set of mindset. You need a different mindset. You need a different way to look at the market when you're dealing with when you're dealing in this category. And I think Harsh brings that mindset to us. During his time with Tata's, I think for about 3 years, his fund was voted as was named as the highest. In fact, gave the best returns across market cycles. And mind you, that was a hybrid fund. I'm talking about the cash equities part of that fund, right? Which is what we are trying to replicate in our Dynasif long short equity fund. So Harsh is somebody who comes with a lot of experience. I think, like he always keeps telling me, this is one of the most exciting categories for a fund manager also to be involved in, especially if you are a believer in active fund management, because the range of things that you can do in this asset class is quite fantastic compared to say a traditional mutual fund and a traditional index fund, right? You are like me a big believer in, especially in the India context, in active fund management. I think this is a in some sense a paradise for those fund managers. And yeah, so I think Harsh and I, he's been with us for the last 7, 8 months, and in fact has been very instrumental in building out the whole platform, our product suite. This is one out of four that we hope to launch and launch very quickly, because I think as many people point out, there's no track record in this fund because this industry is only 6 months old. But I must share one statistic with you. It's about 7,500 crores of assets are already in as of January, almost about 25,000 investors, right? So it's not a category which people are getting very decent flows. It's a category which investors are asking for. And to my mind, my MFD friends, especially if you're the ones who are certified and the ones who hope to be certified, I think you will have a foot in the door quickly, because unlike other products, the banks are not fully certified yet in a big way. So at least the recent fundraisers that we have not seen banks participate in a very meaningful. It's largely been an MFD driven collection, right? So the two big pillars of collection in the recent things have been MFDs and of course direct. And direct collection is telling me that there is fair amount of demand for this product. Customers want to put money, so it's now our job and your job to try and find that customer and bring him in into that pipe, right? And partner with us. So super. I'll stop here, Suren, if that's okay, and then I'll hand it over
Yeah,
to
sure.
Harsh. Harsh, yeah, boss, you're the boss of the show today.
Yeah,
You're the
yeah, Harsh, so before we get into Dyna SIF, just if you could just take everybody through in terms of what are the categories of the SIFs which have been introduced, and what's so unique about SIFs, and specifically touching upon the derivatives part, which Raghav and I have been talking about.
Yeah, sure. Good evening, everyone. So my name is Harsh. I've been trying to build the 360 SIF product bouquet. Very similar to mutual funds, SIFs have been launched in three categories: hybrid, debt, and equities, as it would appear in front of your screens. And by the word, hybrid is a combination of different assets, including equities and debt. There is one asset allocator category as well, which is equity, debt, and commodities. Then we have pure debt, and then we have pure equities. In equities, we have three large categories: equity long short, equity X100, and sectoral long short. Equity long short is allowed to take positions across market capitalizations, both on the long and short side. So it's the most it has the largest scope to go anywhere within the equities. There is no constraint on theme, sector, or market capitalization. The second is X top 100, which means that it will lean heavier towards the companies which are below top 100 in terms of market capitalization. So by name itself, we should be able to understand that this would be more mid and small cap heavy, both long and short side. Then we have sectoral long short funds where you will have very significant concentration of specific sectors in the portfolio, both on long side and on short side. So sufficient to say the third fund, which is sectoral long short, will be very risky because there will be huge concentration on sector bets. So ideally, it will show a lot of volatility and therefore it also has the highest potential to make returns. X top 100 and equity long short are similar, except that X top 100 has to have a greater allocation to mid and small. So these are the very exciting categories within the equities. Specifically, the difference versus, let's say, a normal mutual fund scheme with respect to these categories is that you can undertake short positions as well on both debt and equities. Now, in debt, there is theoretically nothing that you can short except to manage the duration of the bonds, or let's say take a call on whether the interest rates are going to go up or go down. But there is no way to currently to short a corporate bond. So it's a theory, but let's say in future, if our debt markets become stronger, we start getting debt derivatives instruments also, then debt shorting will become applicable for many of these funds. As of now, we will focus our attention only on equities, equity derivatives, because that is what is liquid, that is what is practical. So on equity side, you can take 25% unhedged shorts. What does this mean, unhedged shorts? So let's say if you buy these stocks, you expect these stocks to go up, and then they do go up, you make a return. Similarly, you can place a bet that a stock might fall by 20% or so. So you can place that bet through equity derivative, let's say equity stock future, take a short position in that. And if the stock falls by 10, 15% or 20%, you will make money on that. So shorting is selling the stock without owning it and then buying it back at a later date. To the extent that the stock price falls, it will be a profit for you. Just in case the stock goes up, it will be a loss for you. Very similar to the long, but in the opposite direction. So this is something which is new to the SIFs. Now this becomes relevant and important for the investors because now investors are not, they don't have to just depend on stocks going up for making returns. They can benefit from multiple stocks that go down as well. And as you all would have noticed, every single year, no matter what the market faces, there are always some companies, some sectors which go through their own pain points, and those stock prices decline.
So Harsh, is
So
this allowed in mutual funds as well? This short positions, etc.
no, mutual funds cannot take short positions.
Okay.
AIFs and PMS can do, but if you take short positions in AI for PMS through derivative and you do make money on that, it will go into full taxation. But in SIFs, because the taxation is only at the investor level when he redeems from the fund. So let's say if you are invested in SIF for 5, 7 years,
Mm-hmm.
there's no taxation to be paid at transaction level.
Sure.
Only when the investor redeems, he will be paying that 12.5%
So
LTC.
it also has a pass-through, status basically.
The derivatives income effectively becomes your long-term capital gains in a SIF.
Yeah. No, SIFs has a pass-through status just like the mutual funds.
Yeah, same taxation
Yeah. Sure.
as the mutual fund. So there is a clear advantage that one, you can make money through shorts. Second, whatever you're making money by participating in the derivatives market through a SIF, that will qualify as LTCG if you hold for that minimum holding period. In which, in case of equity funds, it will be likely 1 year. In case of hybrid funds, it will be 1 year or 2 year, depending on what the scheme is doing. Uh,
Sure.
the second difference is with the rule use of options. Now, a mutual fund scheme has power to buy options. The same power has been extended to SIFs as well. But mutual fund schemes have significant restrictions when it comes to writing of options. Mutual fund scheme cannot write put options, and when it is doing covered calls, Then there is a significant limitation that it can do covered calls only on the Nifty stocks, that too up to 15% of your overall equity portfolio. But for SIFs, there is no such restriction. You can write covered calls on the entire equity portfolio if you so choose to.
So
And you
there is
can
no
also write
15% cap, unlike mutual funds. It's you can write option
on,
writing on entire 100% of the portfolio is what you said.
yes, you can write it on the entire 100% of the portfolio, and you can obviously write it on the stocks that are outside Nifty 50.
Of course. Okay.
Yeah.
Sure.
Plus, you can write put options. Now, the relevance of this writing of options is that they are generally yield generating strategies. So, if the stocks remain or the markets remain in a range, you will most likely end up making some returns out of options writing. It is not a guarantee, but it works only in the scenarios when the markets are very, very stable, or the stocks do not go up and down, they just remain where they are. So you'll end up making returns on the options that you have written. So they fit very well with some of these hybrid strategies. They tend to reduce your portfolio risk, but at the same time, they cap the upside. So many of the hybrid SIFs that are being launched, they are being launched basis this options writing strategies, whether it is covered calls or callers, whatever you may call it. And some of these outcomes will therefore become very different from a normal hybrid scheme of mutual fund. It's
Sure.
possible that the markets remain sluggish, range boundish, flattish. So in such scenarios, you will see that SIFs will start doing hybrid SIFs will start doing better versus their counterpart mutual fund schemes.
Sure.
Uh,
Harsh, one question which comes to mind is how deep are our markets for these short positions and this option writing at this point in time?
yeah, I think it's a great question. So I will take a step back and give you a trading volumes context. So in India, the highest trading happens in index options, followed by index futures, followed by stock futures, and then we have stocks. So if you are, let's say, looking to buy, let's say if you want to buy 100 crores of PI Industries, so stock futures of PI Industries would generally have almost 3 to 4 times more volumes. So you could fill up the trade with lesser impact costs if you're doing it through stock futures rather than the stock itself. And then in the end, we have stock options. So stock options is sort of illiquid in the market. So if you, let's say, get a lot of AUM in your SIF hybrid schemes, it will become somewhat difficult to exercise these option strategies. But if the strategy is relying on equities, on equity futures, then I think there is no limit to how much AUM you can handle. I think you could easily become the largest schemes as well. But yeah, as far as usage of stock options is concerned, it will be restrictive in terms of how much AUM you could manage effectively in that scheme.
Sure. We've seen some of these SIFs getting launched recently, like 7,500 odd crores, which have been collected. So have these SIFs been able to restrict the downfall comparatively to a broader market, let's say mutual fund product, etc.?
So see, most of the SIs that have been launched are on the hybrid side, like I said,
Ah,
and they're using options as a strategy.
hmm.
So have they fallen less than Nifty? The answer is yes. But they were supposed to fall less than Nifty right from the start because it's a composite of your
It's
debt
a
and equity.
it's hybrid one, correct.
It's
But
a
any
hybrid one. So
any
it's a
example on the equity long shot?
so equity long short, we have there are two schemes that are running currently. There is one X100 as well, and there are two equity long shorts. One of the equity long short funds is very, very conservative. It's more like a hybrid than an equity fund. The other one is somewhat more aggressive. So one that is conservative has definitely fallen less. One that is aggressive, it seemed to me that its stock picks might have gone wrong because it seemed to have fallen more than the index. See, why
Sure,
I say
sure.
that the stock picks might have gone wrong because even if you're 90% long and 10% short, ideally when the market falls, you should fall less.
Yes,
If your 90% portfolio does as much as Nifty, so if the market has fallen 10%, you will fall 99% on your long book. But on your 10%, if you're again following, participating along with the market, that 10% shorts should have made you 1% return. So the fund returns actually should have been 9 minus 1, minus 9 plus 1, in fact, minus 8% when the markets are minus 10%.
that's true.
That's the broad arithmetic, but if you get the stocks wrong on each side, then it will show up in volatility. So I
Of
think the
course.
second AMC might have got this stock selection wrong.
Sure. So now 361, you launched your recent proposition of Diana, SIF equity long short on 6th of February and closing on the 20th February. Now, could you tell more about what this Diana SIF equity long short product is all about? And while we go along, you could also relate to these examples, what you just spoke about on a derivative side specifically.
Sure. So Dyna equity long short is essentially a equity strategy where bulk of the allocations, which is 80 to 100%, will be in stocks. This 80 to 100% allocation includes the naked short positions as well. One that we explained, that if you don't own the stock, you short them and the stock prices go down, you make money. So the total equities exposure, long side and short side put together, has to be minimum 80s. It can go up to 100%. At no point your exposure, including equities, equity shorts, and the debt and the InvITs, it cannot exceed 100%. So leverage has not been allowed to SIFs. It is exactly same as what is there for mutual fund schemes. Uh, but apart from that, these allocations, we can also look at debt and InvITs, but that would be somewhat defensive posturing. If we believe that the market fall is imminent and we are looking at a severe fall in the market, in such cases, you may want to cut out on your equities and replace it with debt as well as InvITs. So I think we will be using some of these when we are facing those critical conditions, stress conditions, when the maybe global macro is failing, and that might have an effect on the Indian markets with some kind of severity. So in such cases, we will be having allocations into more defensive instruments like debt, REIT, or InvITs. But in normal market conditions, this fund will rely largely on its stock picking on the long side and on the short side. Now, the objective of the scheme is to get both of them right, which is we would want our long portfolio to outperform benchmark. We want our short portfolio to underperform benchmark. Now, key concern for the investors remain that how do we control this risk? So it's important to diversify. So let's say if I want to take 10% short bets, ideally I would like that these short bets are spread across 10, maybe 8 to 10 names with average exposure of about 1% in a single name. Where we have very high conviction shorts, those exposures might go up to 2%. Similarly, on the long side, it will be a diversified bet across sectors and stocks. Let's say if we are positive about capital goods as a sector, and we feel that there are two companies which are executing very well. One is Larsen, the other one is BHEL, BHEL. Now, in our analysis, it could come that BHEL has significantly higher upside versus Larsen. Larsen might be showing 15% upside, BHEL might be showing 40% upside. I'm just giving illustrations. This is not the real analysis, but just from illustration purposes. So in such cases, the higher allocation will go to Larsen because it is inherently low risk a stock, whereas BHEL is a higher risk stock. So while even though BHEL might be offering higher upside potential, its allocation on the long side will be lesser because the stock is inherently riskier. So when we construct this portfolio long and short, we keep the risk in mind as well as the return potential. So if something is highly risky, it will get lower allocation. If something is safe and is looking good, it will get higher allocations. So when we construct the portfolio in this manner, generally the volatility of the fund will be lower. It will exhibit some resilience even when the markets are falling. So that's the first thing that gives the fund a strength. The portfolio will look more resilient. It will show in the NAVs as well. And in order to achieve outperformance on the long portfolio, we have a very comprehensive process which looks at top-down macros, which looks at which sectors will outperform. It looks at the companies which are expected to do better. It also dissects the market in terms of which factors are working, which stocks have strong price momentum with them. So there is a quantitative framework as well. So we get signals on both quantitative side as well as qualitative side. And at the intersection where things are looking good from all aspects or more aspects, which is qualitative, top down, bottom up, and quantitative, price strength wise, factor wise, we tend to place bet. When we get confirmation signals from multiple approaches that we apply, generally the hit rate tends to improve. Market tends to reward those stocks much faster. So which is our key strength, which is why we feel confident that this fund should be able to deliver well, both on the long and the short side. Apart from that, there is a dynamic equity allocation process. So theoretically, and this is just for our understanding, how does the fund, or what can the fund do in different market conditions like bull, bear, or volatile? So in bull markets, largely the fund will have to do very, very well on its long book, where its long book has to outperform the market. When it does that, you will see that the fund returns over the market will be superior. At the same time, the derivatives book does not necessarily have to be short. If you feel that there are just too much good news on the stocks, on the sectors, at the macro, you can tilt the derivatives portfolio on the long side as well. So it is not compulsory to short; it's an optionality, and the amount of short that the portfolio will take will depend on multiple factors, which is looking into market outlook as well, and it will also look at the downside potential associated with each company. If you feel, if you find that there are certain stocks where the downside might be about 30 odd percent, then it might make sense to take some bets on those kind of stocks. So the downside potential itself in some stocks might be higher than the upside potential in the other stocks. So in that sense, it can become returns additive when you have placed both the bets correctly. In bear market, obviously, this fund will do much better than the index simply because you have a short book which will make you returns. Your long book is anyways smaller, and it's theoretically possible that you can create, if you feel that the market crash is imminent and it's going to be severe, you can create an arbitrage on the entire equity portfolio and yet have a short book open on the derivative side. So just theoretically speaking, while practically it is very, very difficult to implement, but theoretically speaking, if the market crashes, it is possible for the fund's NAV to actually go up, provided I have taken arbitrage on the entire equity portfolio and created a short on the derivative side. But that is again very, very difficult to time the market. But at least that optionality is there, that the capital can be preserved or you can even benefit in such bear market conditions. In volatile or flat market conditions, you will have to largely rely on your stock picking skills. Long book has to outperform the index, short book has to underperform the market for you to make alpha on both the sides. And in such flattish market conditions, range bound market conditions, your alpha visibility will be very strong because you will be making some money somewhere. There will be some derivatives strategies that we might implement, which we spoke in the beginning about, writing of covered calls. So those will also come in very, very handy in such market conditions. So what you can see here is that for all market conditions, SIFs have been given the tools to generate good returns better than the markets. That being said, choice of the strategy, choice of the instrument is very, very critical. We definitely will not be right 100% of the time. Even if we are right, let's say 7 out of 10 times, your returns outcome will be significantly superior versus a normal long only fund. But you ought to still be right more than you are wrong. That is the key success factor for the strategy.
Yeah. Tell me, in terms of the hedging as a strategy, what will be your strategy around this entire hedging piece in the normal markets and the stressed markets?
Yeah. So in normal market conditions, you may not want to hedge too much. You just have to focus on getting the sectors and stocks right. I think our likely positions in allocation between longs and shorts in normal market conditions might be 85-15, which is 85% long and 15% shorts. I don't believe that we need to take 25% full short bets in the fund in normal market conditions. And that 85-15 might also be an average number over the life of the fund, assuming there will be bull markets, there will be bear markets, there will be normal markets. That's the number that I intuitively believe will play out: 85% long, 15% shorts. And for such a strategy to do well, it just has to focus on the right kind of sectors, stocks. 85% in my view is good enough to beat the market alone. And further, we are going to add returns on the short side, which is tilted on the 15% positions, which are tilted on the short side. In stress markets, it becomes very difficult. Firstly, the most important thing is that this allocation ought to change a bit. We'll have to reduce the shorts to maybe 80-75 and increase the shorts. So longs will come down to about 75%. Shorts will increase to about 25%, 20 to 25%. That's about the stress markets. But at the same time, the choices that you have in longs and shorts will determine a lot. So in such defensive market conditions, you'll have to go with stocks that hold the ground. So the tilt on the long side will become more large capish. It might become even more REIT and InvIT like. It will go into the stocks that are less macro sensitive, more resilient, with lesser volatility, low beta stocks. Similarly, on the short side, you will try to look at which company sectors are going to get most impacted by the fall in the market. What is it that is driving the markets down, and which companies will struggle the most in such an environment, and place the short bets. So it's the composition of both longs and short matters. The allocation long between longs and short matter, but also the composition. So that's what it is. Third is, obviously you can create an arbitrage on the equities portfolio also, which is another added option for such a situation.
Sure. But given your experience, where do you believe higher returns could be, extracted out of? More from short positions or option writings, where the premiums, etc.?
I believe the naked shorts makes the best returns if you're a good stock picker.
Sure.
Uh, Covered call options or options writing also makes, but I believe that there will be too much influence if hybrids.
Hmm.
Uh, this is just again my intuition, and if there is just too much money, and then they are somewhat illiquid as well as we discussed. So if a lot of funds start writing or start playing on the option side, especially they start selling, they will depress the prices a bit. So it may not turn out eventually as lucrative as what it appears to be right now. But your long short strategy for a good stock picker, it's always a scalable structural strategy. You cannot go wrong on that. If you can construct the portfolio correctly, there is no dearth of liquidity over there. So it's a lot more scalable, lot easier to execute a pure long short strategy, which is why we are launching equity long short fund as the first fund, because our idea is to make it as a flagship equity go-to strategy for the investors, really make it a large fund. Therefore, it needs to be relying on something which is more scalable, which is more timeless in that sense.
Sure, sure. My next question, Raghav. Raghav, we have only about less than about 4,000 odd distributors, who are qualified to participate in SIF, right? Selling SIF. Where do you think this number going up to? And also in terms of what initiatives is 361 taken, to educate MFDs more so that they can qualify this SIF. You're on mute currently.
I hope
Yeah,
I'm audible.
yeah,
Yeah,
yes,
I
you
think I think two things. I think one is you know the when the regulation came out, I think there was the only NISM 13 which had the whole derivative syllabus attached to it, amongst all the various topics that were there. Now, one thing that I think is happening uh, with the regulators, that if you see the topics in NISM 13, there's a fairly large play on currency derivatives. Because the exam is common, Surin. Whether you're going to sit in a stockbroking company, or going to sit in as a SIF distributor. So obviously that currency derivative has no role in this product, because as Harsha is explaining, this is largely equity, right? And to some extent fixed income whenever that
are.
opportunity presents itself. So I think one representation being made is to sort of cut off the currency derivative, maybe. So like how, if you remember, in the PMS we had slight dilution in the exam. I think you will have that coming around soon, which will make it much easier for people to get past the academic part of it. Coming to, I think what we are doing, I think we're doing a fair amount. I mean, we've tied up with a lot of people. We've done a few mock tests. We've have, in fact, done close to about 14, 15 training sessions, covered about 500 odd partners. Yeah, but I think the only advice I can give you from that experience, Suren, is before you start the coaching yourself, I think get yourself a date for the exam, because that's proving to be a bit of a challenge in
Uh-huh.
especially the metro cities,
Right.
right? So I think, let's say if you're planning to give the exam or you're enrolled for the course today, and let's say your course is going to go on for say 2 to 3 weeks, I think it's good to take exam date 4 weeks out right now before you start doing this, because I think
Then start
what we've
preparing.
noticed it is, as like in everything else, effect of coaching unfortunately wears off quite quickly. Because unlike your other exams where there is some connect between, let's say, theory and practice, in this one, frankly, it's more theory. The practical part of the whole thing is actually done by people like us, right? It's really not our MFT friends who are going to go out and do the whole derivative management. I think their job is to essentially just explain to the customer in very simple language as to how important this particular product is in their product suite. So I think that will happen today. So, but the good thing is 4,000 in about 6 months, because the exam essentially got notified in July. And so almost every month you're seeing like almost 1,500 people getting added on. Big again, I'm repeating, big opportunity for my MFT friends, because for whatever reason, the banks are a bit slow at it right now. Maybe last quarter end, etc., etc. Maybe I'm not sure the reasons, but it's a great opportunity for you to take an innovation to a customer. Normally, the reverse happens, if you know, in our experience, or in that typically banks are the one who take out the so-called innovative products to customers here. So here it's absolutely the reverse. So I think it's a great opportunity. So my friends, please don't lose it, because I'm sure someday the banks will get up, and when they do, they will they will really go. Their ability to scale is very, very good.
Tell me, in terms of the expense ratios, are they quite pegged like the mutual funds? And
Exactly the same.
okay, sure.
The mutual
So
fund, the mutual fund rules. It's an all-trail model. There's no ability for any manufacturer to do anything apart. So everything else is the same. There's a direct plan which is exactly similar to a mutual fund, how it works. The total TR minus the average distribution cost is your direct plan. In this one, it's a regular equity fund for us, Surendra. What we're doing now, the long short, Dyna long short equity. So we'll be having the regular full charge 225. So yeah, we have a distributable TR of about 210 to 208, 210, depending on the expense, what comes out at the end of the year. And yeah,
sure.
I think one thing that 361 tries to do is try and support my partners. So we have a reasonably good structure, perpetual trail structure out for our friends here. And yeah, then the same slabs apply. So the first 500 crores, then next 250 crores, next 2,000
Okay,
crores.
so
The
exactly the
same,
same.
exactly like him. Yeah.
And how about the tax implications for an investor?
Exactly again, like equity mutual funds, hold for
Okay,
12 months, long-term capital gains. But of course, I think if you're less than 12 months, it's short-term at 20 and
20%. Sure.
surcharge, right? So same thing. And in the hybrid categories, one needs to be a bit more careful
Mhm.
for two reasons. I think one is equity. Of course, as you know, we have a daily inflow and outflow. You can do a redemption daily. In hybrid and debt, this product differentiation is that you have to do it in an interval-based structure. So effectively, you won't have a daily redemption. You may have a redemption availability only twice a week. And that too,
Sure.
there has to be a notice period given. So I think that's important to all the people in this call, because when you're doing a hybrid strategy, please check. Let's say if we were to give a notice today, which NAV will be applicable, and then after that NAV, when will the money hit your account? Because we are so mentally tuned to giving a redemption, let's say and getting money back in 2-3 business days, that that is a difference between. But in equity, that's not there. So Dyna long short equity has redemption purchase available on all business days. Usual timeline to pay money out, I think 3 working days, it will hit the customer account. Taxation is the same, expense ratio is the same, disclosure is the same. Every month, you will see our fact sheet, which has all the positions that Harsh spoke about, our longs, our short positions, everything will come out very clearly there. So, yeah, it's very, very similar.
Sure. So, Harsh, one question has come up, which is very interesting, is that uh, what kind of alpha would this fund generate, uh, over and above, let's say, a regular flexi cap fund? A long only, I'm specifically talking about.
See, I cannot comment over the category because this alpha generation is again subject to the accuracy of the strategies that you deploy. accuracy of the allocations that you deploy, and accuracy of the stock selection that the fund experiences. So it's a composition of everything. Uh, for us, for me, I will be happy as a fund manager if I can beat the benchmark with great consistency on a quarterly basis, if not quarterly, then half yearly basis. I believe that if you are able to consistently outperform on regular basis, it will ultimately compound to large numbers. So this is about how we are going to do. Secondly, the outperformance of the fund in stress market conditions and bear market conditions and in flat market conditions will tend to expand, because this is, you have the optionality to shorts, and the shorts will make you decent returns when the markets are choppy or they are falling. So therefore, you definitely have an edge in certain market conditions. In bull market conditions, your stock selection accuracy has to be very very good for the funds to outperform. Over a full market cycle, there is a reasonable chance that the fund would have outperformed market by a very handsome number.
Sure. And is there any minimum net equity which
Yeah.
you will always hold?
Yeah, so I think the question pertains to minimum net equity. So like the allocation suggests, the minimum equity has to be between 80 to 100%, which is inclusive of your longs and shorts. But when the word net equity comes, and I'm sure that this gentleman, Mr. Mukesh uh, Thaktani, would have heard about AIF pitches, which is why he's using the word net equity. So net equity is your unhedged longs minus your unhedged shorts. So that can be zero. If we believe that the markets are going to crash, you can create an arbitrage on the entire equity portfolio. You can add some shorts as well. So net equity, sir, can fall to as low as zero if you believe that the market crash is imminent. That being said, on the average, and in 95% of the occasions, we'll operate between a net equity number of 60% on the lower side to 100%. It's only on those rare occasions when the market crash looks imminent, we will look to reduce the net equity significantly lower.
Sure. Any impact of STT increase on these strategies?
Yes, yes. Because they are using derivatives, these strategies will be impacted by the STT increase. My sense is that arbitrage industry, which uses these derivatives to the largest extent, will be impacted by about 30 bips. SIFs will be impacted by 10 to 15 bips per annum. And BAF category, hybrid categories of mutual fund, which also use derivatives, they will be impacted by 5-6 bips. So when you're looking at the impact, you got to look at the relative impact for different kind of fund categories.
Sure, sure. And how will you position it with compared to, let's say, some other long shot? How would Dana SIF be positioned?
So it's difficult for me to position against the other long short AI, because some of them are very low risk, some of them are higher risk.
Surin,
This,
can I just take this point? I think the three
Sure,
parts
sure.
to slightly differentiation. I think one is, uh, as I said, I think one is the strategy. Like Harsh is very clear, and we are very clear that this particular long short equity is an alpha strategy. I mean, the idea is to try and give good comparable equity based returns over a medium to long term period of time. So I think that's very important to all of you who are in the call, because thanks to the use of derivatives, your net equities, like the gentleman asked, can vary substantially, right? So I think you have to be very clear as to what you're getting into. In this case, we are very clear. So please be aware of that. Number one. Number two, I think at 361 we have a very high active stock coverage on our research. We use a fair amount of AI to actually boost coverage. So we track 500 odd stocks, and that adds to, and research can be common across all the strategies, whether it's a mutual fund, SIF, PMS, or AI. And of course, then after that, it is up to the individual portfolio CIOs to then take their decision. But Harsh has that ability to tap into a very, very deep pool of research, which 361 gives it. Lastly, I think, like I mentioned in the beginning, there is fund manager alpha here too. So I think it's important for you to And Harsh has a good track record in Tata's. In that 4-year period that he was there, I mentioned some statistics to you. He did much better than comparable indexes, and then more importantly, that did much better than comparable competitors also. So yes, these are the three things that I would like to say, Suren. And I think Advisorkhoj should be very much clear on top as to writing what the positioning of the fund is, because the rest of it is going to be like pretty much the same in terms of English. But if you get that positioning statement right and communicate that to your partners, Suren, I think that will be a great service that you'll be doing.
Sure.
Harsh, I don't know if you want to add anything to this.
I mean, so to keep it very short, there is a beta part to the fund and there is an alpha part to the fund. Beta is your market sensitivity of how the fund will perform if the markets were to fall, and that is where the fund positioning comes in. So I think even if there are other long short SIFs, you should ask this question: what is the tentative beta going to look like for these funds? And then second question is obviously if you are going to compete against the benchmarks like Nifty 50 or BSE 500, how much is the alpha going to be over a long period of time, and where is this alpha going to come from? What is the experience of the investment team or the fund managers in running such long short strategies? If the AMC does not have experience in long short, they are primarily relying on the longs, they will be doing something on the shorts. Then what is the AMC's track record on, or let's say the specific fund manager's track record on the long side? I think this is the important question that I would ask as an investor. What is the beta of the fund? What is the risk positioning? And how much confidence do I get as an investor that a particular fund manager or particular AMC will be able to generate alpha versus the benchmark? I've already told you there are specific tools that have been given to SIFs to generate alpha in all market scenarios, which is a plus point. But again, being the ability to use these tools comes with some kind of experience, so that is very, very handy and important to analyze from your perspective.
Sure, sure. Any further questions from our viewers? Okay, so anything sorry, go ahead, Raghav.
No. Sorry, I just wanted to close by asking for partner support. I know Advisorkhoj and we have a long partnership. I think the way to do this and I think I compliment you guys on this, is that it's education first, convincing yourself. Maybe you could put some of your personal money if you feel like, as a test case. That's what many of my successful advisor friends do. But I think it's a category. I'm happy to sort of share this with my friends, family, partners also, because I have three things, as I said, for the sake of repetition. We have a great strategist, a very good portfolio manager with a demonstrated track record. We have a great stock selection library to choose from, which has got very much ability to track uh, out value as well as overpriced stocks, which allows us to play the long and the short parts of the strategy. And lastly, I think we are very, very clear on our positioning as to what each of our strategies will do. So I think especially given the nature of markets, and I think I think customers are really looking for something where, in a flat market, they don't want to be told that the index has given 7-8% and the fund manager has given 0.5% more. So sorry, your return is 7.5. And if you can show them something a little additional and explain maybe in a shorter format than what we have taken, I think there is a reasonable amount of demand that's there for products like this. So I think I'm very confident of this strategy. I think it suits our brand also very well. 361 is the leading wealth manager in the country. Most people who who are going to participate in this strategy, Surya, in my mind, is that they would already be having 40-50 lakhs of portfolio investment in some form or the other, be it in direct stocks or mutual funds or other options. And I think that 361 brand resonates very well with them. Diana is a very nice name, and of course the colors are great. So I think it's got all the it's got all the marketing elements put in. It's got all the design elements put in. It's got all the fund management elements put in. And then I think now it's just up to you guys to take it to as many people as you can think of. And yes, I think, and let's grow this business together. It's a very, very exciting business.
True. Harsh, any closing words from you?
Oh yeah, I mean, so I basically love long shot. That's what I've been trained in for all my life. My first job was as an analyst working for hedge funds. It was unfortunate that long short remained very curtailed in India through Cat 3S, where the taxation was very high. So while I did put in my best efforts there, but even though the fund was beating every single fund in India, I'm not just talking about the long short industry, but also the mutual fund categories. And it was like the number one fund within the 50 funds for 3 years in a row. Still, I collected only 3,000 crores AUM in my fund, and that was a capacity for the long short AI. But this is very very special because now you have an opportunity to scale the business significantly, materially. If I'm able to repeat even half of the success that I have had in Tata's, this will very soon become a 10,000, 15,000 crore fund in no time. For the active fund manager, for someone who likes to identify good ideas, I think this is a special category altogether because when you analyze or look at 200 stocks, 250 stocks, and you find okay, these stocks will definitely outperform. When your process is like that, you also come across these stocks where you get a feeling, okay, these stocks are supposed to go down. Now, if you're running only a long only fund, you deprive yourself of that pleasure of shorting the stocks which are going to go down. You probably also miss those ideas as well when you're learning only long only funds. But for a discerning eye, for a fund manager who loves active management, who believes very deeply into active management, this is the go-to strategy. And to be able to make money on both the sides. And I can also tell you that, from my experience, while, some of the stocks that I have bought, they went up multiple times. But the pleasure I got while shorting these stocks and they went down 20-30%, I think that pleasure was significantly higher than, getting the stocks right on the long side. So it's very, very, positive for me. It's very, I'm actually very thrilled that this strategy is going to go live. I'm sure that this fund will become a very successful fund over a period of time.
Absolutely. No, I completely agree with you, Harsh and Raghav. And, I would just like to add here to both of you is that uh, SIF as a category is definitely going to balloon, just like mutual fund in some times to come as we have more momentum coming in from more distributors qualifying to sell SIFs, in the times to come, which will certainly happen. And I think more pertinently, if you look at any mutual fund or you look at any other category where a long only portfolio is being managed, of course, the skill of the fund manager always comes in which stock he needs to pick and sector rotation, etc. Multiple other things, right? So that skill, of course, is required. But one very very particular skill which is needed in this product is a derivative strategy. Correct. So that's the main, I think, the differentiation, which an SIF to an SIF will behave differently. Correct. And I do believe that Harsh comes with a great amount of experience in that background. So fantastic. So well, for our viewers, would request that let's give that exam and get our SIFs, get going. And if you already have, then it's a good product to take a look at. And so thank you very much, Raghav and Harsh, for taking us through, what Diana
Hey,
SIF is.
sorry, I'm just gonna add a PS there. You don't need an exam to make an investment, Suren. So please invest in your personal capacity, even if you don't have to give the exam.
Oh,
I
yeah.
think it will.
Oh, yeah, yeah, yeah. That's a good one. Yeah, yeah. So let me just repeat what Raghav said. For you to make your own investment, you don't need to qualify for an exam. It's only for making others to
You
invest as
don't
a
qualify the exam.
distributor.
Yeah. So yeah,
Fantastic, fantastic. So thank you very much, Raghav and Harsh, and thank you everybody for joining in today.
thank,
Like we said, it will be a crisp call of 1 hour, and we end exactly at 5:09. Thank you very
Suren,
much.
thank you,
thank you so
friends.
much.
Thank you.
Thank you, Suren. Thank you, everyone. Thank you.
Thank you.